A single IRA withdrawal at age 73 can quietly raise your taxes, increase your Medicare premiums, and shrink your retirement income. That's a specific, hidden cost that caught Bill and Sarah off guard, and most people never see this coming. It's not about doing anything wrong, it's about the laws that govern traditional tax-deferred accounts. Bill and Sarah spent decades working hard in suburban Ohio. Bill spent 34 years coordinating logistics, and Sarah spent 28 years counseling kids as a school advisor. They retired with what they thought was a bulletproof plan: $800,000 in a traditional IRA, a small pension of $22,000 a year, and their steady Social Security checks. Honestly, they felt absolutely secure. "We did everything we were told to do," they told themselves. "We played by the rules." Let's pause for a moment, because we need to look at what they missed. When Bill turned age 73, they encountered a number that changed everything: a mandatory annual distribution of over $32,000. "That can't be right," Bill whispered when he saw the calculation. The kitchen clock kept ticking. Under IRS regulations, the government forces you to take these forced withdrawals whether you need the cash or not. By the time many retirees notice the impact, the decision that caused it may already be behind them. This is a delayed consequence that threatens the long-term survival of your savings. But here's the good news: you still have time to prepare, and you don't have to face this blindly. Here's one small win you can complete in less than 5 minutes today: pull out last year's tax return and find your adjusted gross income line. Knowing this single number is your first step to taking back control. If you don't check this, that mandatory withdrawal gets added straight to your regular income on your tax return. On paper, it looks like you suddenly got a big raise, pushing you past key income thresholds. That brings us to our first major trap: your Social Security tax. Imagine receiving a letter from the IRS showing that up to 85% of your hard-earned Social Security benefits are now subject to income taxes. How did this happen? Sarah asked, staring at the tax bill. Sarah adjusted her glasses. When your total paper income crosses those thresholds, your benefits are no longer left alone. But right now, you can protect yourself. Here's what you can do right now: ask your advisor which account you should withdraw from first, and why. By coordinating your distributions, many retirees manage to keep their income safely below those IRS tax thresholds. But the tax trap has one more hidden step: your Medicare premiums. When your income increases because of forced withdrawals, you can be pushed directly into a higher Medicare premium surcharge tier. Instead of paying the standard Medicare premium applicable for that year, you face an extra monthly charge per person. For a couple on a fixed budget, those monthly bills can soar, forcing you to cut back on travel, delay home projects, or trim down your retirement lifestyle. Let's turn this mistake into a plan and look at how you can protect yourself. First, what should you check? Take a close look at your traditional IRA and 401k statements. Write down your total balance so you can estimate how large your future mandatory withdrawals might be. Second, what question should you ask? Ask your CPA or fiduciary advisor, can we run a tax projection to see if partial Roth conversions now could help keep future forced distributions from pushing us into higher Medicare premium brackets? Third, what mistake should you avoid? Avoid the mistake of assuming your retirement planning is finished once you turn 65 or retired. Many retirees assume that tax-deferred accounts are always best to leave completely alone until they are forced to touch them. Taking strategic distributions earlier can save you thousands later. Before we wrap up, let's look at a quick 4-step retirement safety checklist you can keep on your desk to help you make progress this month. 1. Find last year's tax return and circle your adjusted gross income. Put your traditional IRA and 401k statements in one folder. Write down a list of your steady income sources like pensions and Social Security. Schedule a brief tax review with a fiduciary professional before the end of this year. This checklist isn't about getting rich. It's about protecting what you've built. 5 years from now, you'll be grateful you prepared before it became urgent. The future version of you may never remember this fear, but may remember the decision you made because of it. Our generation was never taught this, and this conversation could save someone thousands of dollars. Send this video to someone who thinks retirement planning ends at 65. So where are Bill and Sarah today? They don't have a perfect, effortless ending, and they still pay close attention to the rules. But they sleep much better knowing they have a plan in place. What worries you most about retirement? What do you wish you'd learned earlier? Has Medicare ever surprised you with unexpected costs? Share your thoughts below so we can keep learning together. If you believe more retirees deserve to understand these hidden rules before it's too late, join our community by subscribing to help us build a place where ordinary Americans can navigate retirement with confidence. You work too hard to lose sleep over rules no one explained. The goal isn't to predict the future. It's to prepare for it. Disclaimer: this video is for educational purposes only and does not constitute formal tax, legal, or investment advice. Always consult a certified fiduciary advisor or a qualified public accountant before executing traditional account changes, conversions, or investment transfers.